All right, number three. The number three misconception. I can't qualify for a mortgage if I have any debt.
Yep. So this one's easy to combat, right? So when people look at their monthly debts, oftentimes even before they filled out an application, I'll have conversations with clients and they're like, "Oh, well, I have a $30,000 car loan." Okay, here's the thing. We don't look at the $30,000 car loan. We look at what's your monthly payment. So the way we calculate your qualifying number, your qualifying income, it's based on a debt to income ratio. It's basically all of your monthly liabilities, your debts that you're paying. So again, not this total balance. So your $5,000 credit card balance, we're not looking at that. We're looking at the minimum $100 payment. Again, I'm not saying go out and get debt because again, you have to pay that off.
Especially don't get debt if you're under contract already.
Yeah, don't get debt and don't go open new credit cards.
When you're under contract, don't go open a new credit card.
Don't buy a car. Don't go to RC Willie
or just don't do anything until you talk to Holly first.
Yeah, because we will get people that they're like, well, we wanted to buy a house, so we went and opened it. We thought we needed to open up these new cards, so we had these more credit available, and it actually ends up hurting them because their age of their credit then just got.
Which is actually the credit cards is another misconception, I believe.
Oh, yeah, so we can get to that.
The credit card.
But yeah, moral of the story is you're looking at your monthly payments. So you'll take, if you make, again, I always go easy numbers because I don't like doing math in my head. You make $1,000 a month. You have $100 worth of monthly payments. It's your monthly income divided out by your debts. And that's your debt to income ratio. So a debt to income ratio on an FHA loan, you can go up to, tell Micah, I get into the weeds. So just bear with me for 2 seconds and we'll get there. When you buy a house, you have a front end debt to income ratio and you have a back end debt to income ratio. This front end is going to be your mortgage payments. So your principal, interest, taxes, and insurance is your front-end debt. That number over your monthly income is 1 ratio. Then we'll have our back end, which is now all of this debt, your principal, interest, taxes, insurance, plus car payment, student loans, credit card payments. All of that is now added together, and then you have the second ratio divided out with your monthly income. So an FHA loan, you can go up to 56%. On the back end, front end, you can go to 46%. Conventional loan, you'll be 50% on both. And so it's just managing that. And again, you're going 56% or 50%. It is your pre-tax earnings. So it's not what actually goes into your bank account. It's what you earn before everything is taken out of it.
I got another misconception real quick, and it's related to this, and it's not in our list, but it has to do with debt. Mm-hmm. And I'm not sure if this is a misconception or not, so I'm kind of going to put you on the spot here. But I've heard lenders don't necessarily look at medical debt or health bills and all that. They don't look at that. Is that left completely off, or how does that work?
So it used to be included, but there was some legislature that went out and it's removed completely. So we can see it a lot of times on a credit report. It depends on how the credit report is ran. Because I'm like, I have seen medical debt on a credit report that we've run before, but it's not included in that debt to income ratio.
So that's good. I know medical debt is a huge thing right now. Health insurance is crazy. A lot of people don't have it. You get in that one accident at home, you break a leg, and all of a sudden you've got tens of thousands of dollars of medical bills. So good to know. That's not included when you're applying for these mortgage loans.
And then even people talk about student loans as well. And it's like, okay, how much of my student loan is marked on my monthly debt? Because a lot of times you're not making payments if you're still in school. A good rule of thumb is 0.5% of the balance is what they're going to factor in as what your payment would look like. So if you're looking at, okay, I know I have the student loan, how much is it actually going to hit me? Think of 0.5%.
So it's not necessarily the amount of debt you have, but more of your monthly payments on that debt.
Yeah, that's ultimately all it's going off of is your monthly payments. And again, your credit card minimum down payment, not down payment, but minimum payment.
Minimum monthly payment.
Minimum monthly payment. Again, I would never recommend that. Just pay off your cards and don't pay interest on things.
And we'll talk about credit cards here in a minute.
Yep.
But that's another one of our misconceptions. But let's go to number 4.